Good day, everyone. I hope you had a great weekend and got plenty of rest. As usual, we have a lot to talk about today. Starting with the fundamentals, we had the existing home sales report come out today. Sales of previously occupied homes in the U.S. slipped 1.2% in June to a seasonably adjusted annual rate of 5.08 million. The anticipation was 5.27 million. So we came a bit lower than expected. The slowdown was partly to blame to the increase in interest rates that we have been seeing very recently. Keep in mind that we are still at a 3.5-year high, so the report was not that negative when looking at the big picture. Existing home sales are followed widely by fund managers and economists and provide a broad indication of the state of the economy. Any signs that the U.S. economy recovery is slowing can depress oil prices, which started the day a bit lower and dropped below Friday's low as the day continued. Crude is still up nearly $14 a barrel since June 21st, based on concerns of supply disruptions in the Middle East and expanding U.S. economy. In my opinion, the last few trading days have been very technically driven. The expanded range we saw was expected, and now we're approaching serious divergence, oversold relative strength index, and a closing at the low of the day on high volume. Everything is pointing to a short-term correction, which is warranted at this time. Expect prices to go down to the 104 level in the short term, and we will go from there based on the trading action and the fundamentals. The stock market was very mixed today, with McDonald's reporting quarterly earnings. The earnings came below expectations, and the stock traded down 3% for the day. The stock market is moving higher, but without any momentum behind it. The fact that the small caps are also moving upwards is comforting because small cap stocks are riskier stock picks. So if funds and investors are accumulating them as well, and they are, the rally is a real one. Although very unusual to say the least to see the market making highs in the summer on low volume, I'm convinced that if the Feds were not helping the economy, we would be seeing a totally different picture right now. Notice that the transports did not go higher today, which is a telling sign that the rally we are seeing is very limited and does not have much behind it. I'm watching the transports closely right now, and I'm not seeing much evidence of higher prices. The semiconductor sector is also very soft in light of the overall stock market, so I do believe we have to be very careful in this type of market conditions and extremely selective. The technology market is lagging, and this is not a good sign for a breakout market. I will keep you updated on this because what we are seeing right now is once again not very typical. The gold market finally rallied to a reasonable selling level. However, the triangle breakout suggests there's more upside here, at least to the 1350 level and possibly higher. I've been patiently waiting for this market to rally, and although I'm very bearish on gold long term, I do believe based on the technicals that we're going to rally against the major trend just a bit more. Based on the strong resistance level near the 1400 level, I'm comfortable waiting a bit more. Anything higher than we're at right now is a bonus as far as I'm concerned. Truthfully, but for the Feds keeping interest rates low and stocks high, the gold market would probably be approaching the triple digits right now. So I'm glad we can get a chance to sell this market at a reasonable high level. Either stay long for a bit more or wait till I give a sell signal to sell this market. I may also want to spread it against silver because of the tight correlation between the two markets. The US dollar broke the short-term support level in early trading and was rather calm in afternoon trading action. There's not much trading range or unusually high volatility, which suggests that we may be going lower than I planned. But watch for the 82 level carefully, and if we break it, we will be going down to the 80.5 level shortly after that. Usually, when markets are maxing out in one direction, you will see heavy volume and very extended trading range. We are not seeing that here at all. This shows me that the trading in the dollar has not reached strong emotional levels just yet. If we break 82, many traders who went long at the 83.5 level and higher will be closing out or reversing positions. And this is when things will begin to get interesting. The British pound broke out above the 153 level as we anticipated last week. Unlike the dollar, volatility is increasing, but not to a point when I'm overly concerned with the market peaking out just yet. Monitor the trading range tomorrow, and if you see a much wider range day with extended volatility, you may want to lighten up on the position because this market is going to retrace within the next few days. Several setups for tomorrow you may want to look at. There's a long tail gap setup on TTT and a long 4x4 setup that looks really good on Google. There's also an inside day long setup on ASML tomorrow as well. These three setups fit the criteria well and will provide you good examples of what good setups should look like. That's it for today. I will update you tomorrow morning. Have a great night, everyone.